Would you say that a lot of your investing success you would attribute to luck?
A huge part of it. Success in investing is about luck. If you want to become a serious, mature investor, believe that your results are solely due to your skill.
You've actually gone on record to say that retail participants shouldn't be investing in IPOs because it is rigged against their favor.
Multi-baggers are the curse of investing. It distorts the way your mind works. You stop thinking rationally. You become like a beast, like an animal in search of prey. That's not how it works. Selling is the dark continent of investing.
Yeah.
Very few people know how to sell well or sell smart because there are no textbooks written on it. All your books are on how to buy.
How are you thinking about the next 20, 30 years?
That we begin to understand what it takes to succeed when you operate on a global scale. We need to believe and champion certain virtues that are not seen as being very high up on the list right now.
Which ones? What are the signals to look for when one should sell? Because, there's so much hype even
One
in the last...
is when every man and his dog is talking about that company as being a great investment. I mean, खरीदना चाहिए boss. बहुत.
I also heard you say in a video, I pray for an event like a financial crisis to happen in my lifetime.
The more it's hit by adversity, the stronger it becomes. When the world has beaten down good, bad and ugly, you have a bunch of really wonderful companies available at throwaway prices. And then all you've got to do is... If I'd had the ability to just have one virtue, patience, I'd have been rich beyond my dreams. Most people can't visualize what it'll be like 10 years later.
What do you think will happen in the industry?
First, there'll be, as Rakesh Jhunjhunwala, my other friend, used to say, अभी तो सिनेमा खत्म भी नहीं हुआ, इंटरवल भी नहीं आया है.
Hello and welcome everyone to the India Opportunity Show. Today I'm privileged to have with me Sanjoy Bhattacharya, a seasoned investor known for his contrarian views and long-term investing success. He's probably the guy who's had the most multi-baggers in the Indian stock markets. And we'll talk about so much of his investing wisdom in this episode. For any young investor who wants to learn about public markets or starting their investing journey, this is a fantastic episode for you to learn from his wisdom, which transcends decades of investing success. He spoke so highly about his friends, Ramdev Agarwal, Rakesh Jhunjhunwala, and so many other fantastic investors who've shaped the Indian financial ecosystem. If you like this video today, remember to subscribe to us so that we can keep bringing you more such episodes. Hope you enjoy watching. Sanjoy, welcome to the India Opportunity Show.
Thank you very much.
Such an honor to host you today because you don't do interviews very often.
That's true.
And we are missing you from the media, public limelight.
I'm not sure about that.
We are missing
but
your
very kind of
wisdom.
you. Very kind of you. Yeah.
Sanjoy, before we start, I know that your father used to teach accounting at IIM Ahmedabad. And accounting, as they say, is the language of business. And going back to your childhood, early years, that must have really trained you in the investment world in some ways.
The interest in investing, actually my dad never invested in the stock market till very late in his life. He had a very negative view of the Indian stock market. He used to say it's a gambler's den. And I think as I look back, certainly in the late 70s, early 80s, he would have been right. And he took to it very much later in his life. I think the first time my dad made an investment in a listed company was in 87.
Wow.
As recently as that. And he passed away in 93, so he didn't have much time. But I actually got into it earlier. I started in 83. So
tell us about your early days. What was that initial first?
I spent a year studying at the Harvard Prep School for professors' kids in 69-70 when my dad went to Harvard. And in those days, it's very funny. My dad used to teach Section I. Two of the students in that Section I were Tom Peters and Michael Porter.
Wow.
And they used to come home for dinner. You know the chap who became head of McKinsey, what is his name? Rajat Gupta. He's a Bengali and he loved Bengali food. He used to come to our house. Punendu Chatterjee. They're all Harvard Business School of that vintage.
Wow.
69 to 71. And they all used to come home, and little did I know that Rajat Gupta was such a great guy, or Punendu would strike it so big, or Tom. And Michael Porter and Tom Peters, both, when they wrote their book, sent my dad autographed copies of their book with a handwritten note.
Because they are literally the textbook version of what
So I
competitive
met
advantage.
these guys as students of my dad's.
Amazing.
And they used to take me to basketball games, ice hockey games. With them I used to go along. And I didn't see them anything else as some of my dad's favorite students. I didn't realize Michael Porter was going to invent this wonderful five forces model then. He was a nice guy, really nice guy. And that's what, and he's passionately interested in basketball, the NBA.
Right.
I said, great, yes, so am I, so is he. Let's make a good time of it.
Yeah, as a child, you're not thinking
You're not
about
bothered
these
about
things.
it.
Amazing.
Yeah.
That's fantastic learning ground for anyone.
I was really lucky. I was blessed.
So would you say that a lot of your investing success you would attribute to luck? Because a lot of these circumstances...
Investing is, whether we accept it or not, a huge part of it. Success in investing is about luck. So I think one of the real important things is never to believe, if you want to become a serious, mature investor and focused on getting better, to believe that your results are solely due to your skill.
But a lot of people believe that it will take
Good for them.
the credit
Good for
on
them.
TV.
I think it just reflects on the kind of individuals they are. But I know this for a fact. I've been, doing this now for a long time, perhaps longer than I should. But I do know for a fact that the single greatest determinant of investment results is luck.
Wow.
In my case, I'm the living example of it. I'm absolutely, I bought Infosys in 1994 end when I didn't have any clue about information technology, computer, hardware, software, nothing.
Why did you buy it?
I bought it because I was very impressed when I was a broker then with Warburg. And I took a client, Edinburgh Fund Managers, to meet a guy who actually, I think, was one of the most influential people in building that company, a guy called N.S. Raghavan, who was Mr. Narayan Murthy's co-founder. There were actually only two guys who co-founded. Now they talk about 7.
Yeah.
The other guys were all little kids who were sort of been hired. But N.S. Raghavan, who subsequently went on to chair the Murugappa group as the group chair, I was so struck by him, by his honesty, by his insight, by his belief about, where this business could go and what you needed to do to succeed, that I said, I don't care a hang. I don't understand this business, but I'm going to buy it.
So you were betting on the jockey in this case.
On the opportunity.
So you understood
the size of the opportunity.
Tech sector.
I'd just gone to Japan just before that. And, I'd seen technology at work influencing people's lives in Japan. So I knew what software can do, what sensors can do, and how it affected people's lives. In 1993 in Japan, on the sidewalk, you could get a warm meal from a vending machine, which you still can't do in the US 30 years later. That is technology at work for you.
Right.
So I experienced this firsthand, and I said, if this is what N.S. Raghavan thinks, gosh, that's the impact it has in Japan, I can't imagine what it'll be like in India. And I bought it. And that's probably, it's my most productive investment in my life in terms of returns.
Did you hold on to?
I held it for a long, long time. I held on to it from 94 till 2017 with very minor sales in between, trivial sales.
Wow.
And it doesn't speak well of me, incidentally. It shows something that I want to say, which is that as an investor, I've still got a long way to go.
Yeah, you mentioned that I should have sold Infosys
In 2000. Any right-thinking guy would have been, absolutely nuts not to have sold it in 2000. You had a company trading at 110 times earnings, current year earnings, which, despite all the hoopla about Y2K, was growing at 27, 28, 30%, and which was seen in global terms a pretty small company. And therefore carried lots of risks about being blown away by others and, someone coming in. They had just lost their biggest client a few years ago, GE. which was their biggest client in the early 90s. That was a great act of, now it will be called vision, then I would say courage. Narayan Murthy said, these guys are not going to bully us. If they think they can make us cut rates, if they think they can squeeze us, it's not for us. We'll find someone else. And GE was then, if I'm not wrong, 25% of total Infi revenues when Narayan Murthy made that decision. So, I should have sold it. Ramdev Agarwal, my great friend, he sold it at 9,900. And he's smart. But I didn't. I hung on to it because I fell for these lopsided...
But isn't that smarter that you didn't sell?
No, not at all. You got to be objective about these things. You got to be honest. It was the height of stupidity. Knowing when to sell and understanding the issues involved, making intelligent decisions about selling is, I think, even more difficult than making intelligent decisions about buying and structuring a portfolio. As I've said before, I think selling is the dark continent of investing.
Yeah.
Very few people know how to sell well or sell smart. Because there are no textbooks written on it. All your books are on how to buy. All your war stories and all the folklore is about buying. I've seen two books, one by Justin Mamis and one by another guy, on selling, which talk about war stories on selling and how it happens and what you need to keep in mind. But
that's so true, because the common narrative is also that you should hold on to certain companies for 30, 40 years.
That idea now is gone out of fashion, if I may say, with no offense meant to anybody. The buy and hold forever was a wonderful thing in Phil Fisher's time, in the 1930s till the 1990s. He held Motorola for 60 years, as everyone knows.
Yeah.
And Motorola is a truly great company. But the level of change that is taking place in global business, and more specifically in India, is now much, much more rapid and much, much more dramatic in terms of its impact on the business.
Right.
In 2024 than it was, let's say, even in the 90s. The internet, as a very vivid and simple illustration, has changed the way we work, the way we do business. And maybe, again, this is my typical fluky type scene, but I'm willing to make a bet. You'll be around for sure, I may not. 20 years later, I think you will see AI.
Yeah.
It's the next big thing. And it will you won't even dream that you're not doing certain things in a way as compared to how you did them now.
But that's already true in 2025 now.
No. We've seen nothing. We've seen nothing. AI is going to be transformative.
Yeah.
It's going to change a lot of things. How your kids get educated, how when you fall ill, you're looked after. It's going to change even the nature of your personal relationships in some ways.
Wouldn't you say it already has? Like all
not at all. We're not even at the...
Yes, at very initial stage. But if you look at companies like
Meta... Not even the tip of the iceberg right now.
Yeah, but if you look at companies like Meta, they are already shaping behaviors.
They are one of the companies which has really been at the forefront of AI as a business, where they've been impacted by it as a business.
Yeah.
At the forefront of AI. But that's one company in 100, 200, 500. Yeah. But if you think of the rest of the companies, which company in India has really been deeply influenced by AI? None.
Yeah, I struggle to find Indian examples.
You can't. And even globally, I mean, there are only a handful of companies yet. Maybe Microsoft, maybe Google, maybe Amazon, maybe...
ChatGPT, DeepSeek.
So these are all, and then there are these new things like Anthropic and whatever. But what fraction of businesses, I'm not talking about market cap. Everyone in India jumps onto, Amazon market cap is so and so. Microsoft market cap is 2.4 trillion. I'm saying, as businesses, what proportion of businesses today are truly influenced? And this is just one part of AI, large language models. Yeah. This is trivial.
Yeah.
This is not AI will look like 20 years from now. 20 years from now, it'll be like when I walked down the street in Japan. I was hungry, I wanted a meal, a warm meal. I put some coins in, there was a sensor, and I got a warm meal.
Yeah.
AI will be like that. It'll affect your life in that simple a fashion.
But it'll be all pervasive.
I think so. I'm one of the big bulls. I don't know a damn as always. I haven't a clue. But I'm a big believer.
You've been right multiple times, so maybe you're right about
That's more by luck than skill, I think. But I think AI is the next big thing. I really do.
And talking about the India opportunity, because a lot of companies will be disrupted with AI. But if you just think about some of the opportunity that is in front of us in terms of India growing in terms of market size and also dominance across the world, how are you thinking about the next 20, 30 years?
First, I won't be around. So I'm not too obsessed about it. I leave my daughter to handle that. But I think the really big thing is that we begin to understand what it takes to succeed when you operate on a global scale. The dimensions of success of an international business are considerably different to what you need to succeed in a more small, localized
Yeah.
sphere. That's a big change that most Indian companies will need to transition to. Second, I think in terms of our work ethic and our value systems, there's a huge gulf of a difference between where we are today and where we need to get to. We need to believe and champion certain virtues that are not seen as being very high up on the list right now.
Which ones?
Corporate integrity.
You talk about that a lot in terms of
We just
business.
don't demonstrate it. There cannot be a difference between what you do and what you say at any level, whether it's leadership or whether it's the company. And in India, we glorify it by saying we're jugadu. We glorify this misbehavior. We've made a virtue of it by saying we are very jugadu. If you think so, you think so. I
Yeah.
can't change your mind, and I'm not Raja Ram Mohan Roy. So
Yeah, but it is a dream to be
that's the
able-
second thing.
Yeah.
I think another thing that, to succeed, that India will need to bring to bear, Indian companies will need to bring to bear, is the ability to genuinely foster meritocracy, not cronyism. Today, I think one of the saddest things about a large number of Indian corporates is that they actually encourage cronyism.
You
As
think
a way
that
of
way
getting
about
forward.
the new age tech stocks as well?
Less so, much less so, much less so.
Right.
So, but if you look at the big behemoths, if you look at corporate India in general, there's no question about it. This whole culture of ours, this, subservient, self-seeking, that kind of culture, that needs to change. And speediness of response, the ability to respond promptly, even if you make mistakes, would be much, much more important. We've got to realize that the best results come from using resources intelligently, and that applies to human beings, just as it applies to other kinds of resources.
Yeah.
And I don't always see that as being the case in India.
Do
right
you
now.
see there's a hope for an Indian company to become one of the largest
Oh, yeah, yeah.
companies by market
Absolutely.
size?
Undoubtedly. I think why just one? There'll be.
Many, hopefully.
Yeah,
That's
there
the
will
dream.
be. There
Yes.
will be. There will be, for sure.
Which companies do you think, in terms of sectors, could potentially be added to the list?
It's really very difficult to figure that out, Shrishi. I mean, it could be, in a place where we really haven't done very much right now. I mean, it could come from healthcare. If the pharma companies learn to adapt and not become victims of what I think will be disruption caused by genomics, caused by AI, caused by various things, I think it could be a pharma company if they adopt it and handle it well. It could be a services company, like an airline. I know I'm dreaming here, but maybe Indigo, 15 years later, is one of the largest airlines in the world. They got a lot going for that idea
Yeah.
because you have a huge home market. And by that time, Indians hopefully will be better off economically and they'll want to travel the world. Most people fly their flag carrier. Yeah?
Yeah.
It could be also from manufacturing. I think Indian manufacturing has come a long way and I think it will go much further. So they've got many of the elements right.
Yeah.
The one element which is not yet in evidence, is the ability to focus on high value add. Right now, Indian manufacturing is a converter. They buy raw materials, they're very efficient, they convert it into low-end products very well. And if you look at America, it's the polar opposite of that. So America doesn't bother about doing low-end conversion. They're focused on design, they're focused on, innovation, building new products altogether.
It's all about 10x better and not incrementally better.
So some Indian companies will get that, and they'll get there.
The reason why I was asking was because I'm very curious to understand, how in the 90s in the US, it was all primarily banking, FMCG, retail stocks that were eventually replaced by tech stocks. Yeah. And now they have their Mag 7, which account for almost 30 to 40% of their market cap, depending on the day.
Correct.
So can that be true for India?
Absolutely, will be true. It's true in all markets, Shrishti. It's the evolution of the economy. And now in today's times, how, given the interconnectedness of the globe, 50, 70 years ago, business was not as interconnected and global as it is today. This will only continue to become more and more obvious, the interconnectedness of the global economy with our economy. And so, as the world changes, India will change. And within India, the people who adapt better and are more flexible and proactive, they will succeed, and they'll succeed. Some of them, I think, will succeed in spades.
I also heard you say in a video where you said that I pray for an event like a financial crisis to happen in my lifetime.
Because I've been blessed in that sense.
Because that is the only real shot that someone has at getting rich.
Absolutely.
Can you explain it to the younger audience how to think about it?
It's fairly straightforward. Anything that I say is always very simple and obvious. Because I don't have the brains to indulge in complexity. But it's like this. Investing is fundamentally about risk. And cutting down risk with the idea of trying to buy something that's going to compound in the long term, which is robust, and to use one of my friend's phrases, anti-fragile. In other words, the more it's hit by adversity, the stronger it becomes. Yeah? So, when do you get those opportunities? When the world has beaten down good, bad and ugly at the same time, in the same way, without discriminating, what do you have presented to you? You have a bunch of really wonderful companies available at throwaway prices. And then all you've got to do is pick some of the better companies, which many people can do. None of us need too much genius to know that we should buy strong, well-run, dominant businesses that have good management. Yeah. The point is, most of the time, those businesses are priced to perfection. Right? I'll give you a live illustration. So in 2008, companies like Asian Paints, Blue Star, Pidilite, Crisil became available at 14 times, 16 times, 18 times current year earnings.
Wow. I
bought Blue Star at 14 times current year earnings in 2008, end of 2008. I bought all these names, in fact, in 2008.
You bought all of them?
All four of the ones I told
Amazing.
You. But now here comes the non-amazing part. I'm so dumb that I don't own one of them even now. I sold all four.
You sold all of them. When did you sell?
At different points. I didn't sell all at the same time. The first one I sold was Asian Paints again.
You held on to it.
I bought Asian Paints in 1983, sold it in 1990. Absolutely dumb decision. There's a guy who's on the media who's pointed out that what Sanjoy Bhattacharya would have been worth if he just held his initial 200 Asian Paints till today.
Yeah.
And it's a pretty staggering sum.
What is the number?
I've forgotten. I don't know. But it's a pretty damn staggering number. But I bought Asian Paints in 2008 again. And I sold it for 3-4 years later. But the point is this. So you had a bunch of really wonderful companies on sale. Now, it's much easier. You pick whichever. I don't think one has to be prescriptive. You can pick, companies which are in services, which are in technology, which are in across the board. By that time, I'd come around to the view that I'll try and buy companies that I have a better understanding of. So I used to try and buy businesses that I had a faint clue about. here's the mistake I made, selling them. I'm telling you, selling is the key element, one of the most important elements of doing really well at investing. And judging when to sell and when not to sell can affect your long-term investment results massively. So now, what did I do? I had a bunch of wonderful companies available at very, very attractive prices, very low risk that I'm going to bomb with this. And if I had had the ability to just have one virtue, patience, which I think is one of the most important and underrated virtues in investing, I'd have been, rich beyond my dreams. And I've had 3 such opportunities. I've had 92, Harshad Mehta. I've had 2000, which was the Y2K.
Yeah.
I've had 2008, which was Lehman Brothers or whatever you want to call it, the GFC. And then completely event driven, I had 2020, COVID.
Yeah.
And by 2008 and 2020, I had learned a lot of the lessons, at least by reading books and so on. So in these 2, I benefited, I'd say, to some extent. But not, again, when I look back at it in hindsight, I say, how dumb am I? Because even in 2020, I did not benefit as much as I should have.
Yeah, because the companies that you sell and then they appreciate hurt you more.
No. I think this is another important point I'd like to make.
Okay.
There's a popular school of thought, and maybe it's true of the mutual funds, but as an individual investor or as a hedge fund, it's certainly not true. And that idea is that you need to be 100% invested all the time. And the rumor is, and I've heard this phrase repeated, so aimlessly by so many, it is not about timing the market. It is about how much time you spend in the market. Everybody seems to ape this. The question is, when markets are ridiculously overvalued, you shouldn't be spending time then. Because money doesn't grow on trees. There's only a finite amount of capital we have that we can deploy. And if you don't learn how to sell when it's ridiculous, you won't be able to take full advantage of the opportunity when it does come. This year is a terrific example of that. For people who couldn't sell in the first 9 months, 10 months of 2024, they can't participate in the opportunities you have on a platter now.
Yeah.
Because we don't grow notes as yet. None of us have the license from the RBI to print notes. So now you have mouth-watering opportunities today.
Would you call them mouth-watering?
Because
it's a correction.
Again, let's go back to what I believe is important.
Yeah.
You can buy high-quality businesses at pretty reasonable prices. It's your time horizon that matters. When I say mouth-watering is because I think I want to own these for 10, 15 years. And I can visualize where some of these businesses will be 15 years from now. So I'll tell you an illustration of a business that I want to own, which I'm buying right now, which I think will do well for me. It may not do well for me in the next 12 months, 18 months. It's asset management. I worked in an asset management company in India, which is listed now. It wasn't when I used to work for it. It is a business in this country which is, again, just beginning to pop its out of the... And most people can't visualize what it'll be like 10 years later.
What do you think will happen in the industry?
First, there'll be massive scale because India's savings will transition from lower risk, lower return investments into a mutual fund environment. It'll be less fixed deposits, bank deposits, post office, much more financial products.
Right. And we are seeing initial stages of that right now.
Very early stages. There's nothing. Okay. And India hitherto has been a high savings country. Savings to GDP has been pretty high, though it's declining.
Yeah.
Second, and this is really important, why I think Indian asset managers now are much, much more mature and they are doing things that are going to help them to build a great business. Like, for instance, till recently, everyone used to say passive investing is a dud. We don't want to be in such a low margin business. How are we going to make money? You look at all the smart asset managers today, SBI, Nippon, HDFC, all of them are building, and it's still trivial, but they are investing in smart beta products, they are investing in ETFs, they are investing. And when, suppose you have a currency that is liberalized, where an Indian can use rupees to buy anything across the world, they'll offer you products which are like ETFs on any different country, and you'll be able to buy it sitting here.
Yeah.
That's the way forward. If you had a convertible currency, that's the size of the opportunity, the globe.
That's amazing to even think about that.
It's obvious.
Yeah.
I would venture to say it's obvious. Unless we continue to have a non-convertible currency. And it's only convertible on the... But even if it remains that way, let's say it's a worst case, it remains that way. I don't think it's going to be the case. You have so many other opportunities in terms of, for the asset managers, you have the ability to customize products to the needs. Today, you have a one-size-fits-all approach in the mutual funds business, right?
Yeah.
Once you have the ability to reach out to audiences more cost effectively than conventional distribution methods today, which will happen using technology. So your cost of customer acquisition should come down. You can actually deliver to customers much more carefully what they want.
Yeah.
The opportunities ahead of this business, for the whole industry, are just immense. And the smarter guys, I think, that's what differentiates horses from donkeys.
So, अगर कोई अपने 20s and 30s में इस इंडस्ट्री को देख रहा है, how should they evaluate companies, which companies to invest in?
Right now,
What
you
are
don't
the
have
metrics?
much choice. आज के दिन तो 3 ही कंपनी है मेरे ख्याल में, HDFC, Nippon, sorry, you have Aditya Birla, UTI, 4 हैं.
हाँ. So, अगर उनको हम कोई frameworks दे दे जिससे इन
So
companies
this is
को
a
evaluate
question
करें.
I shouldn't answer because I'm biased. Because
Okay.
I worked for HDFC, I was its first CIO,
Yeah.
and I have a huge amount of loyalty and goodwill for them. But having said all of that, the evidence does suggest that it's a very well-run company.
Yeah.
Navneet Munot has done a great job. He's built a fine team. He's putting in place all the right building blocks for the future. So you can turn around and say HDFC is overvalued, it's expensive. And I'd have some sympathy for that. But we're not buying it for today. We're not buying it for 2 quarters. We're not buying it for 2 years. We're buying it for 5 years. And once you have that mindset, then to me, HDFC, it has a great brand, an association, and I'm sure Navneet will nurture and support that. So that should hopefully remain as strong, if not stronger. And that's the compounding of the cash machine. These things lead to compounding of the cash machine.
Is there a part of you that wishes that you were running the business today?
No. I don't like running businesses. I just enjoy investing. And Navneet is a wonderful guy because he understands both sides. He's a fabulous investor himself.
Yeah.
He came from fixed income investing. And he's also a great manager. That's the kind of guy you need running an asset management company.
Yeah.
And funnily, contrary to most people believe, the single most important thing in building an asset management company is not just about having a great investing team, which I think HDFC incidentally does have. But it's also about understanding how you create faith in people over the long haul to commit their savings to you.
Yeah.
That's really the crux of it. This is not sales speak for asset gathering. This is the crux of building a high quality asset manager, whether boutique or large scale.
But if you're looking at certain metrics of the company, would you be looking at ROEs, ROC again?
Sure.
Yeah.
100%. I'd look at, the diversity of the product range they have. I'd look at their capital efficiency. I'd look at employee productivity. I'd look at their long-term investment track record to make sure that it's not below par. I'd look at leadership, very, very important in this business. I'd look at HR very, very carefully because
What in HR?
the kind of people you hire.
Culture.
Culture is the larger part of that. But if you hire people who tend to fancy shortcuts, and there's a great temptation to do that if you're a fund manager. I know guys who've been bribed. I know guys who've got poor character, who've had long innings in Indian asset management.
Yeah.
So you don't want to be hiring such guys.
Yeah, absolutely.
One thing I can say for HDFC, they have created a great culture. Thanks to Milind Barve, thanks to Navneet Puno, thanks to Mr. Parekh actually. He deserves a huge part of the credit for the culture building.
What were some of your learnings of work after working with him?
Have empathy for people, treat everyone fairly. Remember that your reputation is far more important than any amount of money you can make. It's lots of simple ideas. He was a guy who really cherished simple ideas and took them to their logical conclusion
So hard to do in today's time, no?
because it needs guts.
Yeah.
To say that I'm not bothered about the next quarter's profits, but I'm bothered about, building an organization that has empathy, both towards other people whom it deals with and within the organization among its employees, is really tough.
Yeah.
So, that kind of thing.
And speaking of, the market being rigged or the poor performers or the bad actors in the markets, there's a lot of froth in the SME IPOs, unlisted and pre-IPO space as well today.
Yeah.
And you've actually gone on record to say that retail participants shouldn't be investing in IPOs because it is rigged against their favor.
I'd say this is firstly, it's not my idea. Guys much smarter than me but much more savvy than me said this. I've just heard them and I'm repeating it. But the truth is, when you invest in an IPO, let's look at how it works. The guy who's come to sell his business to the public thinks it's a good time to sell his business. That's your first red flag. That the largest owner of the business now suddenly is willing to dilute his ownership.
But that's because they need financing for the business.
Even private. You've heard of a company called Mars. You've heard of a company. There's so many large American companies which are private, which don't have outside. So I don't buy that argument. Okay. Second, they know the financial history and the current conditions that prevail in their business much better than you ever will.
Yeah.
And the opportunity for that business. Right. Third, if they're selling that business at some absolutely ridiculous valuation, which you think will be very difficult to maintain, right, going forward, and you're the sucker. And fourth, and most importantly, you don't have a track record. They don't allow you. SEBI, unfortunately, doesn't make it mandatory for these companies to give you 10 years financial performance.
Yeah. A lot of them don't even have 10 years of a track
Yeah, that's right. If you're a very young company. So that I think is another thing. You shouldn't allow companies that are incredibly young to access public markets.
Really? Because that would be very contrary to what's happening now, right? Like so many tech stocks which are scaling or rapid hyperscalers, as you call them.
If you're a regulator, you're not bothered about just a couple of individuals making money. You're thinking about broadening participation in markets. And how do you broaden participation in markets? When the guy who at the margin has not invested in the market comes into the market and he feels it's safe. So how do you make markets safer? It's not about this wild thing about multi-baggers that Indians have stuck in their heads. Multi-baggers are the curse of investing. Because it distorts the way your mind works. You stop thinking rationally. You become like a beast, like an animal in search of prey. That's not how it works. The best investing is rational investing, is sensible investing, with sensible return expectations and a sensible time horizon.
But people also argue, or people would also argue that there aren't enough listed securities, so we do need more companies to get listed.
Would anyone ever say that about India?
There
are
is an
5,000
argument.
listed companies here. Even if you cut off the bottom end of the microcaps, you have at least 1,000 companies which are listed. I mean, how much of a universe do you want? By just scattering your money about, you're not going to get rich. You get rich by being disciplined, by being patient, by being an owner of a business. But you don't get rich by just saying, I want more and more companies to invest in. No.
That's a common narrative, though, these days, that, the government wants more IPOs to happen so that, there are more
Eventually,
securities
these
listed.
are cycles in history. In stock market history, you allow people to get into the stock market who aren't yet ready to participate in the stock market, and then people go and buy those companies. Some of them are fragile businesses. Some of them are businesses that should never have been listed in the first place. Some of them, don't have the ability to think about the long haul. You know, they're doing very well right now, but they don't have the capability to survive. You know, and as people lose money, they lose faith. A guy like my father, who was a professor of management in the 70s, used to say you should never invest in the stock markets. Why? Not because he didn't know enough about markets or he didn't understand finance or accounting. It was because of what he saw happening in the stock markets, the kind of behavior that was in evidence from all participants. You didn't have a regulator then.
Yeah.
The first regulator came in 1991.
Wow.
So, it's not appropriate to encourage excessive risk taking in an area where the consequences of that may be actually seriously harmful and not easily reversible.
Yeah.
So, I've been fascinated by this idea for a long time. It's an idea called ergodicity. And what ergodicity does is it tells you to think about the consequences of what you indulge in. And if those consequences are not easily reversible, then how that should shape your behavior. It's a truly powerful idea. And there's a guy who's written a book on this. I would advocate that anyone who wants to invest should read this book. It's by a guy called Luca Dell'Anna.
Okay.
And the name of the book is Ergodicity. Because I don't think you figure out the consequences of what you do when you venture into something very little information and there's complete asymmetry between the seller and the buyer.
Yeah. I see that in a lot of funds these days that are looking to get exits with IPOs and are pushing companies towards a public market listing.
The private equity fund.
Yes.
Because they need to get out.
Yeah, because they need to pay back their
Their
LPs. So it
investors.
does cause a vicious cycle in the
Absolutely.
market.
Absolutely.
And, you also spoke about Indian fund managers diversifying a lot because a lot of them
Over-diversifying.
over-diversifying, where they're invested in 40, 50 companies also.
Most of them are 70, 80.
70, 80, right.
Yeah.
What do you think of that broadly, and how can retail participants be better informed about which fund managers to select?
No. That they're very well informed because SEBI even money control makes you disclose your entire portfolio. You can see how many stocks they own. So the information disclosure is not an issue at all in my mind. And retail investors chase recent performance.
Yeah.
Let's be crystal clear about this.
3-year
they all want to-
returns, 5-year returns.
3 month returns. Let's not be dishonest. That's what they're chasing.
Yeah.
So no, but the issue with diversification is if you over diversify, your 50th idea is unlikely to be as good as your first idea. Second, is much more difficult to track 50 stocks or 80 stocks than it is to track 30, 40 stocks. And once you do not begin to remain in touch with what you own, and there is a chance that some stocks will just do badly or neglect because you don't know what's going on. And this idea that we have a large analyst team and we attend conference calls is absolute rubbish because you never ask the barber whether you need a haircut. No management on a call is going to tell you we are about to go down a bolt hole. I've met only one company in my life where the CEO told me, Sanjoy, be very careful of owning my company. There are rough times ahead. And
He actually told you that.
yeah, he did.
Wow.
And you know what? It's staggering. The guy who told me this was a Maori.
So much against the popular belief.
That's right. And I worship that guy for his honesty. But so one is very difficult to track. Many of them get caught between the cracks. One is there are cancelling effects. So you'll have 30 going up and 30 going down. You don't want to have that.
Yeah.
Third, when you over diversify, what happens is you increase transaction costs. Unless you say, I'm going to hold 100 companies forever, which you can't do in the mutual fund industry. So you're increasing transaction cost. And more importantly, as I said, the first thing, the quality of your 100th company, the power of the idea, the power of the likelihood of the returns, the nature of the business, the quality of the business, everything it follows the natural law of deterioration as you go down that path.
Yeah.
So why do it? We all know that after about 25, we're fine. As a measure of risk mitigation, at 25, 30, you're fine.
And that's true for retail participants also. Is that your advice, that 25, 30?
Absolutely. Absolutely. You're not going to get rich on the 100th company you bought or the 60th company you bought. I can guarantee you this. It's tough enough finding 5 good ideas.
मेरे आजकल तो यंग लोग इतना एक्साइटेड होते हैं अबाउट इन्वेस्टिंग इन मार्केट्स की देर टेकिंग
इसीलिए तो वो पैसे बहुत बनाते भी हैं और घुमाते भी, हारते भी हैं.
Yeah. So it's a short way of losing money.
I would say that at some point you can get unlucky. You run that risk. Because how can an individual invest? That's why mutual funds are there. But the tragedy is the mutual funds are doing what the individuals wind up doing.
Yeah.
Individuals have portfolios which have 50, 60 random stocks bought at different points for different reasons. You give it to the mutual funds in the belief that they'll do better. They'll handle it more.
Because that's what I've also observed, that to grow their AUMs, they'll launch so many
Absolutely
different
right. You hit the nail
schemes.
on the head. So if you are running 75,000 crores and the Indian markets are fundamentally illiquid, you're pushing them into owning more stocks.
Yeah.
Isn't it?
So ultimately, you're not going to see
So it's
the
counterproductive.
return. Yes, I agree.
It's a question of, many wise men before me have said there's no challenge. We can have a 200,000 crores fund. Again, about this, one of my favorite phrases. Never ask the barber whether you need a haircut. He's always going to give you the answer that is biased in his favor. Not evidence-based.
Yeah. And one of your very core learnings also, I think Warren Buffett also says that you should think of yourself as a shareholder of the business and not an investor in the company. Can you tell us?
Not as an owner of a piece of paper which is tradable. That's how I'd put it. See yourself as 100% owner of the business. You own that business totally. Now, what do you want to do? You want to own it for the rest of your life? Because if you don't, then you're playing musical chairs.
Yeah. There's a lot of people will put 1%.
So it's very difficult. What I'm saying is highly exaggerated. In practice, not easy to do. It sounds like, an armchair academic. But the fact of the matter is, and I see it every day and becoming more and more evident, you don't buy companies for one quarter's results. And we've all got to recognize that there is no company in the world which can steadily grow earnings month after month, quarter after quarter, year after year. Because that's not the fundamental nature of business. That's not how business works.
Yeah.
So once you accept that, then you begin to ask yourself, what will this business do 3 years down the road? Forget this quarter, forget next quarter. Maybe there's some great quarter, maybe there's some bad quarter. But is this a business that 3 years down the road is going to be stronger because it has a larger part of the market? It's going to be stronger because its dominance in the products that it sells will get extended by virtue of the stuff it's doing right now in terms of research and development or distribution or brand building or product development or any number of things. Is this a management team that is doing all the right things in terms of, making sure that this company will be around in its present form? In other words, one of the biggest things in investing which people don't get is survivorship.
Yeah.
If you just survive and you're around, you will succeed.
Yeah, there must have been so many companies that you also thought were
The
great but are
average age of
non-existent.
how many companies are 100 years old? Microsoft was set up in the 80s. Amazon was set up in the 90s. And I don't know how many of them will be around in 2100. So, one of the most important, Royal Dutch Shell, is survived for 150 years. So, you got to think about survivorship. And survivorship is intergenerational. So, succession planning is a huge part of owning a well-run business.
Which Indian companies don't really plan.
By and large, no.
Yeah.
By and large, no. Yeah. Or you have this spectacle that one of India's best-known companies had of each guy who was supposedly a founder taking a crack at running the company. And you know what I'm talking about.
But when you're looking at some of these companies that can sustain the test of time, it's what are the ways to evaluate those things? What are the factors that you're evaluating?
So I'll tell you. My crude methods for figuring this out. One is, are they investing? It depends, of course, on what type of company you are, okay? Meaning, it'll vary across sector. But
Yeah.
by and large, I'm thinking of manufacturing.
Okay.
So are you investing in developing better products? Or products that are better suited to the needs of today's customers and future customers? That's a very important part of being. So Royal Dutch Shell focused on being environmentally conscious 60 years ago. That's why it's still around.
Right.
The second thing, which is very, very important, is they make sure that the businesses are run in such a way that no one individual can affect the business by becoming so important that it basically becomes his alter ego. That there's a system in place of a group of people who all have well-defined roles and responsibilities will work together as a team.
Right.
No superheroes. No prima donnas. I think most people glorify success. But success can be short-lived. So when you're buying a company for the long haul, you're not focused on today's success. You're focused on the character of the people who are running it and their behavior and whether it's consistent with what they say. And whether what they say is taking a good, careful look at how the company can be around for a long time. The Asian Paints, actually. Not that I ever thought of any of these things ever in my life, but I now think of it, 42 years later, 42 years later, is a wonderful illustration of that. A company which is primed for the long run. It's a very unique
Why did
structure.
you hold on to it?
Stupidity. It's a long story. We don't want to destroy your podcast with that. What is investing actually? Think about it, Shrishti. If you had to define investing in 4-5 words, what would it be?
Capital allocation
That's
in
much later.
in productive assets which are growing.
It's decision making under uncertainty. That's what investing is. And that applies to a lot of things.
Yeah, true.
A surgeon has exactly the same challenge. He's making decisions under conditions of uncertainty and he has to succeed. In our case, we don't have to succeed. That's the difference between the surgeon and the investor.
True.
So, when you want to make good decisions, high quality decisions, you're not going to get every single decision right under conditions of pretty significant uncertainty. You got to ask yourself, what are the things I need to do? And that will give you, lo and behold, the answer to how do I become a good investor? It's that simple.
Right. And, because Safir actually told me that you had mentioned and spoken about mistakes in his book. So I did ask him to suggest a question that I can probably ask you during our interview today. And he said, ask him about the corrections which are happening in the market, because he would have a very interesting point of view. So
it's because of human behavior, the frailties of human behavior, people getting greedy. And now the flip side of that greed, which is fear. That it's like a coin, heads and tails. Greed and fear. They should have it at the Australian Open. You want to choose greed or do you want to choose fear?
Yeah.
But we're seeing the two in rapid short order. So this is about, stock market cycle. There's this guy called Howard Marks. He says it's like a pendulum. It swings from one extreme to the other. It spends very little time at the middle. But the question is, you got to know broadly where the pendulum is. Is it here or is it here? That's why I say, you said 2008, you said I love, situations when there's a crisis, a bear market. Yeah. That's what the pendulum is here. So my point about investing is figure out where the pendulum is.
Where do you think right now the pendulum is in India?
A little bit off center. A wee bit off center, heading towards this side. Meaning heading towards being
the bearish phase.
Yeah.
But that will bring about great opportunities.
But at the end of the day, there's too much excitement also about Bajar su lage. This famous Gujarati phrase, doesn't matter Bajar su lage, yaar. You don't buy Bajar unless you buy, index ETFs, index funds. You buy individual businesses and you buy the future for those businesses. So stay focused on that. Maintain a laser-like focus on owning high-quality businesses. And there aren't that many of them.
Right. A lot of young people will also say that, I don't have the time and effort.
Put
to
money,
be able-
if you can't do it, put money, give it to either someone who can do it for you and who is of high character and honest and decent and not greedy himself, or put it into a mutual fund. And if you don't trust any of the mutual fund managers, put it in, even better, is what Buffett says he'd do with his money, put it into an ETF. Everyone, this country by numbers has the greatest numbers of Warren Buffett bhakts. He's destroyed this
Twitter.
country.
Yes.
No, everywhere. I haven't met a single guy who doesn't say, I am a great believer in Warren Buffett. Bhakt hu main unka. The fact is, none of them have learned to behave like him. They don't remember, because he speaks in this wonderfully witty way and in this, using these wonderful aphorisms. One of the things he said, if you want to finish first, you must first finish. Survivorship?
Yeah.
In spades. No one gets it. They're all obsessed with this moat, goat, this whole theory. I mean, yeah, moats are very important because they determine the ability to compound money and maintain your dominance. But isn't it important to figure out in what ways that moat is changing? The size of the moat. A dwindling moat is actually very dangerous.
Yeah.
Coca-Cola. The Washington Post. Buffett himself has fallen victim to it many, many times. But people don't want to learn from that. They're obsessed with, just the jargon. They don't get down to the essence of Buffett.
What is the essence of
The
Buffett?
essence of Buffett is see yourself as a guy who owns a business, and if you find a really good business, pay what seems to be maybe slightly expensive, but pay a fair price for it today because the really good business will work miracles over time. That is a really good business, a definition of a really good business. One that sustains for years into the future, and that will be much, much, much more valuable 5, 10, 15, 20 years out. His best investment, according to me, in his life is Seas Candy.
Yeah. What a phenomenal growth.
I
business.
love Seas Candy as the product.
Right.
I guzzle it.
Yes. And so, what's the hope for us to find opportunities like Seas Candies in India?
Immense opportunities, Srishti. They're in your backyard. Just look around. Yeah? There's so many. I mean, the most obvious opportunities people don't seem to want to find. So I say, okay, I'm biased. I own the stock. I don't want to be blowing my own trumpet, so maybe I shouldn't use this. I'll say it,
You
but
can,
it's
yes.
it's not. I don't want to be blowing my own trumpet. I'm just trying to illustrate how many opportunities we have in our own backyard, which, for whatever strange set of reasons, we don't want to take advantage of. So there was a company called the National Stock Exchange of India.
Of course. Yeah.
In 2019, the government told the nationalized financial institutions and banks that if you have capital adequacy problem, we can't provide it forever. Why don't you sell some of these assets and do it transparently through an auction process and raise the money? So people were selling the National Stock Exchange of India at a current year earning multiple of 18 times. Now, let me tell you what I think in हिंदी में बोलते हैं ना, संक्षिप्त में मैं आपको बताता हूँ नेशनल स्टॉक ऑफ इंडिया की असलियत. इंडिया का सबसे बड़ा स्टॉक एक्सचेंज, 90% मार्केट शेयर, कंप्लीट कैश मशीन, PAT to sales multiple, PAT to sales in excess of 50%. यानी हर रुपए के जो बेचते हैं रेवेन्यूज, 50% is bottom line.
Wow.
Trading at a multiple of 18 times current year earnings. 93% market share. Okay. And the 7% market share wala is trading at a PE of 55. And this is trading at 18. Can you imagine?
Right. Wow.
And it's in no country in the world you have more than 2 exchanges. The US is an exception, but by and large, there's no country in the world where you have more than 2 major exchanges. So we've already got 2 here. And this is a business which has, in terms of, I think, the single most important thing in an exchange, it has a lead in terms of technology, making the trading experience more comfortable and safe and reliable for the guy who trades on the exchange. And it's integrated. It has a clearinghouse associated with it. And it has, they got into big problems with it because they tried to favor some brokers. A particular person got carried away. The co-location scam. But in essence, they have the more robust technology than compared to BSE at that point in time. BSE, I think, was more a members club. NSE at least had a management team that weren't brokers and involved with people who didn't have vested interests. So I wouldn't say it was the best set of managers you could hope for.
Right.
But at least it had guys who in some sense were not biased. Right? Now, was that a tremendous opportunity?
Absolutely.
Why didn't anyone take advantage of it? Okay, let's say you couldn't buy in 2019 when the auction was there because the minimum lot size in those auctions was 50,000 shares. Why didn't you buy in 2011? It was still available at a PE of 22 times.
But a lot of people might not even get to know about these opportunities, right?
Come on.
How do you
Today's
find them?
younger lot, they know about the rat in the sinkhole. They know every little bit of gossip. They know about everything going on in the world. ChatGPT has transformed and revolutionized the world. So has the internet. You know about everything. I'm unwilling to buy that.
Only what gets picked up on TikTok,
No chance.
Instagram,
No
Twitter.
chance. Everyone knew. NSE is very liquid in the unlisted market. But why weren't people buying it? You have a total cash machine, compounding net worth at 45% a year. How many companies can you name to me that compound net worth at 45%? Look at the size of NSE's profits, yaar.
Yeah. Are you still holding on to it?
Yeah.
Wow.
I've owned it for 5 and I hopefully, as long as things don't change dramatically, I'll hold it for a long time.
Amazing.
That's one lesson I've learned, not to sell randomly.
Right. So this is a long-term holding for you, potentially?
For sure. And it's also my single largest holding. There's no other company that I own which is larger in terms of its value to me.
How much portfolio allocation?
It was not allocation. I just got lucky. So it's multiplied, I think, 10 times in the last 5 years.
Wow.
So
Fantastic.
that's why it's become my largest holding, not when I bought it.
Got it. Let's also talk about a little bit of portfolio construction, position sizing. How do you identify opportunities, and then how do you decide which opportunities to bet big on and where you should take smaller bets, if there are?
I'm going to answer this quickly in the interest of time by recommending a book which I think does a wonderful job of taking you through the entire mechanics of portfolio sizing, which I think is incidentally one of the single most important things in investing. There are 2 guys who've done a great job of this. One is a guy, this is the book I like a little bit more, though it's a bit more mathematics oriented. The Missing Billionaires. This is written by a guy who was the founder of LTCM, Long-Term Capital Management. So he certainly knows something about sizing. Okay, Victor Hagani. And I'll tell you the summary of what he says. The other is this guy called William Poundstone, Fortune's Formula, which is also about sizing. That's a much more narrative-filled, fun book to read. Comes to the same conclusions, they talk about the same things. And the funda is that the basic thing that keeps you out of trouble is when you make a bet, don't make a series of tiny bets because they'll cancel each other out. Much more important to make 3, 4, 5, 6% type bets, to make a few of them, by which they mean 15, 20 of them over a lifetime, like what Buffett says. You have 20 slots
20
to
holes,
punch.
yeah, in the punching card.
And those bets that you make are bets that if the probability of their success is 0.6, remember that that 0.6 won't materialize on the first flip or the second flip. But if they have a 60% chance of coming out right in terms of the businesses being well positioned, then have the discipline to live through the tough times and you'll come out on top. It's very commonsensical portfolio sizing.
Right.
You don't need to be a genius. All these guys who have these 0.7%, 0.8%, 1.1% bets in the mutual fund business, I mean, I don't think they're indulging in rational behavior.
Right.
Okay. Your other question was about portfolio construction. This is a really vexed topic because you can either approach it from the idea of getting a Nobel Prize if you're an academic in America and writing papers on it and fill
We
it with a
need
lot of
it for
mathematical
youngsters
garbage.
who are figuring out how the investing world works.
Own what you understand and what is high class. Don't make something very simple difficult.
What's your definition of high class?
Very capital efficient, run by honest people. Buffett had a test: will I get my daughter married to the CEO? I won't go so far. But I say, to me, and if there's one thing in my life that served me well, it's not my investment skill. It is that I have rarely owned companies run by complete crooks. And there are lots of crooks in India.
How have you avoided that?
By simple native common sense, by observing what they say and what they do. And today it's much easier. The internet has made life for you much easier than it was when I first started investing because we didn't have a way of knowing what they were saying.
Yeah, so how did you figure those things out?
That was my good fortune. I was friends with Ramdev. The two of us hung out together. I mean, so we had a slight, thanks to Ramdev, I had that advantage. But it's very important to own companies. I'm not saying you will find saints in business. If you're looking for saints, go to the Vatican. Business doesn't normally attract people in theology and divinity and the saints. But what I'm saying is that the behavior of the people who are running the company on your behalf, remember you're a minority owner, they're the guys in control, who are running the company on your behalf, their interests and your interests should be broadly aligned. And the last point, you use that word, I love that word, and I know it in a very crude way, but a very simple way. People who don't spend the money that they earn in a dumb way. I think that's capital allocation, broadly, what you were referring to. Same idea.
Right.
Yeah. So I don't like to see personal jets. I don't like to see football teams, cricket teams, hockey teams. I don't like to see them wandering into businesses which they've never been in before, which they don't understand, making acquisitions frequently. So you might say I'm very old-fashioned, like your grandfather. That would be broadly right. I treat it as a great privilege to be compared to people's grandfathers. But
I think the younger generation always says that, but then realizes that the grandfather was right, ultimately.
But capital allocation, and for people who want to understand capital allocation, one book does it, The Outsiders by William Thorndike.
Right. I
Read
love
that book. You won't get it the first time, read it after 3 months. If you haven't got it the second time, read it after 3 months. If you haven't got it the third time, read it after 1 year. Keep reading it till it gets into your consciousness, into your bloodstream. Because capital allocation is the single greatest friend. Rational capital allocation is the single greatest way to ensure that you will succeed as a long-term investor.
You mentioned your friendship with Ramdev Agarwal. I think, having a sounding board where you can bounce off ideas and talk about these things very openly. A lot of people don't get that very easily, but you have found a very solid friendship in that and
Incredible
partnership.
good luck for me.
Let's talk about identifying how you want to partner with someone and finding that right person and then building a long-term
Shared
partnership.
values. You have a common interest which both of us had, which is the stock market. And
How did you two meet first?
When Ramdev left Ram Piparaya and set up his company, which was called Prudential Portfolio Services, that was the original company before became Motilal Oswal. I know him before he met Motilal.
Wow. Okay.
So we were his client number 2.
Amazing.
And Motilal's own brother was client number 1. So it shows you
Wow.
the privilege that
so
I
you
have.
go long back.
Yeah. And so I came to know him through that convoluted connection. But we became very good friends. We've authored a book together, which very few people know about. And,
Even I
it's
didn't.
out of print. To know Ramdev and have him as a friend is really good. I'm blessed.
What are some of the other insights that have informed your investing decisions, or something that he might have said that really sparked a different chain of thought in your head?
He's very, how do I put it, very focused on trying to find growth which is long term, and he's willing to pay up a fairly decent price to buy it right now. He's actually more in the Buffett mold than most people, Ramdev. And
But Warren Buffett would not buy some of the new age companies that Ramdev is invested in.
he hasn't bought too many new
Not
companies.
too many, but like a few.
And many
even.
of those are not bought by him. They're bought by his fund managers. I don't think you should hang Ramdev for those. You're talking about Zomato and
Yeah.
Swiggy and those, na? I don't think they're all Ramdev's buys.
Right.
They
Okay.
don't bear his imprint.
Right.
He may publicly go out and say, yeah, acha lagta hai, but that's not. Those are not.
Right. Fantastic. Any other investors that you've learned a lot from in the Indian context?
I haven't learned enough, but I think
Who do you admire?
Radhakishan Damani.
Of
If
course.
there's one guy I truly admire, it's Radhakishan Damani. It's
What
really,
a fantastic story.
not only a fantastic story, a guy who isn't that educated, but who has such a strong native understanding of what you need to do to succeed in making investment decisions. All of us do MBAs and CAs and PhDs, and we still don't have that native understanding. If you can own VST Industries for 20 years, hats off to you, boss.
And
That's the power of compounding, that's patience, that's knowing what a good business is.
and are you born like that, or is it something that you acquire?
No. Again, a famous Buffett quote. I've read all the Buffett quotes, I think. That's the only good thing about me. Not that I'm a great follower of his. But he says, the better you are as a businessman, the better you will be as an investor. And the better you are as an investor, the better you will be as a businessman. Radhakishan exemplifies that. DMART. And he leaves his CEOs to run the business, and he makes the capital allocation decisions. It's so wonderful. Asian Paints is another illustration of that.
Yeah.
3 families, they do the capital allocation, the professionals run the business. And how wonderfully it works.
Is that the playbook companies should adopt when they're
No,
thinking?
Not necessarily. Not necessarily. I mean, you can be hands-on, yeah.
Safir also said that Sanjoy is probably the guy who's had the most multi-baggers, or identified them very early on.
Yeah, I think that honor should go to me.
Yeah.
There are not many guys I know who own 12, 13 companies that have gone up more than 100 times.
Wow.
There may be. I
Did
don't
you
know.
continue holding them?
No, not all of them. Some of them, but not all of them. But yeah.
So 12, 13 multi-baggers, the person who has multi-baggers under his name.
I don't know
how
about that. I shouldn't say that. I'm sure
But
that
how does one even develop a framework to possibly become...
I've said this before and I repeat it again. Many of my multi-baggers, the 2 categories, some where the entire credit goes to my dad. I continued to own them after he passed away in 93, but he was the guy who's bought them. So Lumax was him.
When he started buying...
He started in 87, in 88 March he bought Lumax.
Wow.
So had he been alive, I think he would have been one of the finest investors in this country. That I am not in doubt. My
And
father
that
would
too
have-
from
I saw him.
someone who
I saw him
didn't
for
believe.
6 years. I know how he used to invest. So I have no doubt in my mind about it. But some of them, Lakshmi Machine Works and Lumax, credit to my dad. My dad also sold out 95% in 92. So he saved us. At that time, we had hardly any money. And whatever money he had, he said, the market is just way too expensive. This is Harshad Mehta. Just go and sell. Tell Ramdev to sell everything. So he made some fabulous decisions in his life which laid the foundation for me. I got blessed because of my dad. I am blessed because of my dad. some of the latter ones are flukes. SSI, just pure luck. A company which has gone out of existence now, which multiply 150 times in 3 years.
Wow.
Because I was in the right place at the right time. I had no clue what I was doing. I didn't know Java. I thought it's an island in Indonesia. Yeah? I didn't know what Java was. I didn't have a clue. What I did know, maybe it's because of my middle class Bengali origins, I knew when something was too good to be true and I sold. Which many friends of mine had exactly the same results as me. Their stocks went up 100, 150, 200 times. They didn't sell and then they went down. They rode the elevator or this thing downwards. I just got blessed. I didn't have to ride the elevator down. And that's why I keep on saying selling is just as important as buying.
What are the signals to look for when one should sell? Because, there's so much hype even
One is when every man and his dog is talking about that company as being a great investment. अभी डिफेंस कंपनीज खरीदना चाहिए बॉस. बहुत गर्म. गवर्नमेंट ऑर्डर्स आ रहे हैं एंड ये बहुत चलेंगे. ऑर्डर बुक देखो ना, 2 लाख करोड़. तो सोचिए कितने साल पैसे कमाएगा. एकदम लंबा पाथवे. रनवे इज वेरी गुड. तो आप रनवे पे ही रह जाएंगे. So another clear sign is ridiculous valuations. Unsustainable valuations. The combination of poor capital efficiency and high valuations is an absolute guaranteed warning bell to sell.
Some would say we were there in the last 2 years.
We're there right now, yaar. Why 2 years? We're here right now.
As
अभी
in
भी
last
है.
2 years.
बहुत सारे मौके हैं ठोकने के. वो गए नहीं है. बहुत बाकी है. As Rakesh Jhunjhunwala, my other friend, used to say, अभी तो सिनेमा खत्म भी नहीं हुआ है, इंटरवल भी नहीं आया है. So it's that kind of scene. Another giveaway, telltale, this thing, is when a company repeatedly raises money after short bursts of time. When it doesn't need the money, but it begins to raise money at obscene valuations.
Right.
That's a sure sign you got to get up.
That's also happening now.
Like nuts.
Yeah.
Promoters are selling their stakes and the गांव is buying.
Every few months.
Promoters बेचते जा रहे हैं, गांव वाले खरीदते जा रहे हैं. तो सोचिए क्या हो रहा है. किस टाइप का अन्याय होगा एंड में.
Yeah.
You can see it happening in front of your eyes. You just don't want to think logically.
So, knowing what we know, are you hinting that it's a time to sell?
I'm not hinting that it's time to sell. It depends on what you're selling. I mean, I wouldn't sell Ingersoll Rand. Or I wouldn't sell lots of companies. But when you own weak companies and they're being treated like princelings, there's a problem here.
Yeah.
History matters.
History doesn't repeat itself, but it often
It rhymes.
Yes. So what do you think we should be cognizant of as Indian retail investors, say, in the next 5-10 years? What are the risks and challenges that
I'm not going to make a prescriptive recommendation here. I'm going to say something, and it's typically me, I repeat myself like a broken record. 1, the greatest challenge in investing is being honest with yourself. Coming to terms with who you are and understanding what you want to do and achieve and your intent and purpose. Your time horizon, your return objective, your ability to the sort of companies you will be willing to own may be very different from the next guy. But that doesn't matter. You've got to be real about who you are to yourself and not cheat on yourself.
Yeah.
So this old Latin saying, know thyself. Very, very important in investing. Second, don't compete needlessly. There's a totally stupid idea dinned into people's head because of their immense ego and lack of honesty. Hey boss, I beat the index by 16% this year. तो क्या उखाड़ लिया? कुछ उखाड़ा तूने? कुछ नहीं. You are not competing against an index. You are trying to achieve your objectives. If you have the idea that within 15 years, you'd like to buy a nice home, you'd like to travel the world, you'd like to put away a stash of money for that, and you're starting out with X and you want to get to Y, focus on the lowest risk way of doing that. Don't benchmark yourself against an index. An index is just a bunch of guys voting with their feet. It's got nothing to do with who you are.
Yeah.
So, have humility. Accept your mistakes and learn from them and don't repeat them. All of us, I mean, we hate selling when what we own is below our purchase price. What's the shame in that, bro? You made a mistake, come to terms with it. Just as winners compound, losers compound.
Yeah.
We seem to understand only the upside of compounding. There is a massive downside in compounding. हिंदी में बोलते हैं ना कीड़े घुस जाते खा जाते सब. So that's part of the story. And most importantly, have patience here. There is no more powerful force in investing than the power of patience. Einstein said it in a joke. The eighth wonder of the world.
Compounding. Yeah.
Ramdev will also tell you that. Ramdev has gotten obsessive about this. Whenever he hires anyone, he says, अगर 10 साल में 3 गुना हो गया, what is the rate of compounding? And if you don't know, you won't get hired. So I groom all the guys whom we interview beforehand. I say, ये बोलना.
That's such a funny anecdote to share with us. You also mentioned that you were friends with Rakesh Jhunjhunwala.
Yeah.
What are some learnings that you took away from him?
Cut your losses as quick as you can and don't have ego. Investing is not about ego. Investing is not about proving to the world you're right. Investing is about making money.
Absolutely. Yeah.
And Rakesh exemplified this. That's why he was so successful. Another thing that I learned from Rakesh, which I think is remarkable, when you buy a business, prepare yourself for the unexpected, both good and bad, because you must know that the future is unknowable. You bought it, set of circumstances, a certain environment, but there's no guarantee that things will remain exactly as they have been and move in a linear fashion in the future.
Yeah.
So constantly orient yourself, figuring out what's happening, how it's changing. And if things are happening that you think are good and that are going to benefit you and present big opportunities in the future, buy more of it at a higher price. If something is very difficult to do,
Yeah.
if you buy something at 100, the price goes to 500.
Then you will feel it's very expensive.
It's complete rot. It may be actually cheaper than the initial 100 you bought it at. Given that at that time the risks were much greater.
Yeah.
And the stock has now got to 500 and conquered a lot of the risks you thought were material then. But he had this unbelievable ability to think long term, tighten. Think what the business is going to look like 10 years, 15 years out. He didn't buy Titan, which was a third-rate maker of watches and hadn't got into jewelry when he bought it in the mid-90s. They weren't even in jewelry then.
Yeah. They were in a lot of debt at that point as well.
Sorry?
Titan was in a lot of debt also.
Not a lot, but they had some debt, yeah. Correct. They're a piddly company, yeah. It used to be owned by Tamil Nadu Industrial Development Corporation. They were the partners of Titan. It was the Tatas and Titco.
Right.
But Rakesh saw something in the future of that company. Some of it came true, some of it didn't. But that's the greatness of the guy.
Yeah.
That he was thinking about what good things can happen to this business 10 years out. When they first, Bhaskar Bhatt and Xerxes Desai got into jewelry, Rakesh was so excited. I said, पागल है क्या? कोई jewelry नहीं खरीदता कंपनी से. अपने फैमिली ज्वेलर होते हैं, वहां से खरीदेंगे.
Yeah.
कोई कंपनी के पास जाके क्यों खरीदेंगे? He said, बट्टा तेरी समझ तो वैसे भी कम है, मैं बता रहा हूँ. सोच इसके बारे में. And how right he was. Investing is about the grind, the hard work. Putting in the hours, the effort in terms of constantly reading and learning new things and thinking about it and then trying to put to work. Which is why I think a lot of today's investors are behind the curve. They've just got stuck into one thing, behavioral investing. Oh, naya mil gaya, it's a fad. Chal bhai. Like, and even there, they don't read the right kinds of things.
It's all borrowed knowledge.
Not only that, they read the low-end stuff. If you're
Yeah.
serious about something, read the best that has been written on it. Read Amos Tversky. Read Daniel Kahneman. Read Richard Thaler.
Yeah.
Don't read the gimmicky little trash that you find in some Mint or Outlook or something. No.
Yeah.
Get to the original source. Ramdev would have expressed this so wonderfully in Hindi. He says, ज्ञान का स्रोत मिलना चाहिए. जहां से वो शुरू होता है ना, उस स्रोत से हमें ज्ञान लेना चाहिए. So, I don't know whether you understood the essence
I
of it.
did. Go to the source directly.
Gyan
to
ka
get-
srot.
Yeah.
That's very important. The second thing is don't be afraid of making mistakes. And don't equate everything in your life to how much money you make or how much money you have and your investment result. Learn to treat investing as one of the important things in your life, but go much beyond it. Be multifaceted, because the more multifaceted you are, the more you'll have the ability to connect from things that are way outside that to maybe investing.
Yeah.
People today are very, very unidimensional. They don't have any serious interest outside that, I want to get rich, I want to get rich. It's floating in their brain at night. Learn how to give your brain a rest, sleep well at night, wake up, enjoy the moment, smell the coffee, do, you've got to have serious things that you enjoy outside of investing. There's more to life than investing. There's music, there's art, there's literature, you should have a passion outside investing.
Right.
Investing is the day job. It's not the fun job.
Yeah.
Travel the world, you'll learn a hell of a lot. If you can compound money at 20% for 20 years, you don't need to bother about multi-baggers.
Yeah.
Multi-baggers will take care of themselves. Just focus every day on how you're going to earn something that you think is reasonable, which a business can deliver, which is in line with how it's valued, and that is part of your objectives. And don't have unrealistic objectives. This whole idea, I want to find a 50 bagger, that itself is criminal, no? Because that's an unrealistic objective.
Yeah.
That's why it stinks. If you say, I want to find a bunch of stocks where I'm going to buy some stocks that are in young businesses, I'm going to buy some stocks run by people who haven't proven themselves as managers, I'm going to buy some much. You're talking about portfolio construction, right? This is my concept of portfolio construction. And I'm going to do this because this is what gives me the shot at earning the kind of investment objectives that I have.
Yeah.
I can't buy 25 replicas of Hindustan Unilever, Colgate Palmolive, every single mature business in town. Can't do that.
Yeah.
It won't work. Right? So what do I need to do to make my portfolio meet my investment objectives? So therefore, what kind of risks what is risk taking? Betting on young guys maybe who are not mature, who haven't proven themselves, but who are in command of a business that is a unique niche. That's good, and some will fail. Don't beat yourself up about it.
Yeah.
If you failure is the first step to success. If you don't fail, you'll never succeed. Be open, accept your failure. Don't try to hide it from others that I failed. That's the great thing about the USA. Fail and fail early. Get up and succeed.
Yeah.
That's not what they teach us in India. In India, you're stigmatized if you fail.
There's so much shame associated
That's
with failure.
right.
Yeah.
Correct. And I think finally, remember that investing is about character. It's about patience, it's about discipline, it's about, being honest, it's about humility, it's about that's what you need to succeed. And that's true of most things you do in life. There are many spectacular batsmen who come and flash outside the off stump. Occasionally they'll hit some brilliant strokes. They'll, the Surya Kumar Yadav, the flick over square leg for 6. Surya Kumar Yadav, when he retires, won't have a great batting average. Or you have the Sunny Gavaskars. They play in the V. The ball is on the ground. They run their singles and twos hard. When they get the bad ball, they put it away. I'm for the old-fashioned Sunny Gavaskar type of guy. When I hang up my boots and take off my cap, I want to have a great batting average and great consistency. If I play 200 innings, I want to have at least 25 50s and 25 centuries. That's what young guys need to figure out. And the hook and the pull in investing are the 3-baggers, the 5-baggers in short periods of time. When they come off, they're spectacular. Taliyon ki gargadahat.
Yeah.
When they don't come off, A, you lose money, and B, you inflict huge damage on your own psychology.
Yeah.
Because we don't know how to live with failure. Very few of us know how to live with ourselves, to be honest with ourselves. So don't do it. Don't do things that are going to be difficult to handle. Tough enough as it is.
Yeah.
Just keep it really simple. The book I really recommend everyone read as the most sensible book written on most aspects of investing. The Intelligent Investor by Benjamin Graham.
Yes, love
Not
that
a surprise, but I think
Love that.
it's a good book. And if you want to go one step beyond that, A Zebra in Lion Country.
Okay,
Ralph
I will read
Wenger.
that. I have
Ralph Wenger.
it. Yeah, we'll quickly do a rapid fire, Sanjoy.
Yep.
One piece of advice for new investors.
Be patient.
Biggest investment mistake.
Buying companies which you don't understand, whose business you don't understand.
Most important trait for an investor.
Discipline and consistency.
Favorite book on investing.
The Intelligent Investor by Benjamin Graham, or Margin of Safety by Seth Klarman, or A Zebra in Lion Country by Ralph Wenger. Any of these three, they've had a profound impact on all three.
Love them. The future of Indian stock market.
Bright. Will do very
$40
well.
trillion.
I don't know. But this is, it's what Buffett says. You're lucky to be an Indian, to be born in India, to be here, because this is the right place to be. When Buffett was born in 1930, he said it's the ovarian lottery.
Yeah.
He was born in the US. He said, if I was born in Bangladesh or Zimbabwe, where would I be? So I think the same logic applies in 2025 to young people who've been fortunate enough to be born in India and who have the money to invest in the stock market.
Absolutely. Is investing an art or science?
Both.
How to avoid market bubbles?
Control your greed. Be objective. Stick with data. Don't get fooled by narrative.
And the last one, thoughts on cryptocurrency.
I think it's junk.
Absolute junk.
Whether absolute or not, I don't know. Can't measure it in that fine detail, but it's junk. It's not a store of value, and there's complete lack of transparency, and I don't think that as a medium of transaction, it has wide enough acceptance for it to be worthwhile.
Thank you so much,
Not at
Sanjoy,
all.
for
Not
taking
at all.
out the time to be with
Not at all.
us here today. It was an absolute pleasure.